Well, we'll get started. We're live. Thanks for tuning in, everyone, and welcome to our kind of newest webinar here on passive investing strategies. This episode is going to be hosted by Venture Capital, or co-hosted, I should say, with Rogers Capital and Techvestor. Kind of the content today, we're going to talk about why our investors prefer passive investing into Airbnbs, and how we're really outperforming the market in that space. So stoked to be joined again by Seif and Danny. I'll let them introduce themselves in a bit after I kind of go through some of the material today. But I figure for those joining, you're either probably an investor of ours, a potential investor, or you're just curious about, syndication, short-term rentals. Maybe you even want to stand up an Airbnb yourself. I think, whatever your background, you'll probably get a lot out of this session today. So looking forward to it. Here's kind of the coverage, though. Agenda-wise, you get a little bit of background on us, our story. We'll talk through kind of the big idea with the fund. What are the mechanics of the investment? So we've now raised two, or we're in the finish line for Fund 2 now, but we'll look back at performance from Fund 1. Why is this asset class advantageous when we talk about Airbnbs? How are we outperforming the market? And then we'll get to probably what most of you are most excited about, which is the numbers, right? How do we make you money? How much do we make you? How do we protect your money? And, hopefully if there's a lot of interest at the end here, what can you do to get involved? I'll point out again, because we're going to be letting people throughout into the session, we're going to carve out as much time as we can for live Q&A at the end of this. So please stick around if you have questions. We'll do like hand raising at the end and fire away. But we'll dive in. So again, we're your hosts. I'm Stephen Gary, principal over at Venture Capital, and I'm joined by CEO of Techvestor, Seif Kafagi, and Danny Rogers from Rogers Capital. So for those who don't know us, I think we can start out with a little bit of a brief background on our story, because I think probably relevant to why we're in the space and why this matters, right? So myself, I spent the last 8 years or so in tech. I was an entrepreneur prior to that for a handful of years, but really didn't find my way into real estate until about 4 years ago. I built what I think of as a really well-diversified investment portfolio, but real estate was kind of this constantly missing piece. And that was due to a pain that I would imagine a lot of you on the call have experienced, which is just time, right? I wanted to do it. I was interested, but even if I had the skills and knowledge to kind of stand up and manage my own Airbnb, I was a full-time exec at a cybersecurity firm. So I had good money, good income, but I was working 16-hour days, and those just don't match up. So as we kind of geared to take that company public, I was introduced to the magical world of real estate syndications, which is, again, what this structure looks like for those who are unfamiliar. It really gives you the opportunity to invest passively and get that exposure into the real estate world. So I met Sam Silverman, a mutual friend of all three of ours. He is now co-GP at Techvestor over with Seif. So when he introduced me here and I saw what these guys were doing, it blew me away. No one's doing this in the short-term rental market, and it was just kind of a no-brainer. So I got involved in Fund 1 last year, made a couple investments, and that's how Danny and I met. My firm, Venture Capital, has been raising for short-term rental Fund 2 alongside Danny Rogers Capital as a joint fund since the onset of this year. So really awesome results there. We'll get into that, and we'll touch on why it's advantageous that we've structured this joint fund in that way. But that's just a bit about my journey. I think overall, Venture Capital is about making these kind of passive real estate investment opportunities easy to the working professional. And Danny, you've had a similar story, so maybe give a little bit of your background before we get into Techvestor and jump in.
Yeah, thanks, Stephen. So first, I just wanted to tell everybody, thanks so much for making the time to join us tonight. This is something we're really passionate about. We think we're on the brink of really a totally different asset class within the real estate market. And, thanks again, Seif, for joining us. This is very exciting. So brief background about myself. I've been in the medical sales space for about the last 4 years. And throughout that time, I've actually started acquiring my own rental property. So I own a total of about 25 units. And what I found out is that, many of you probably feel the same way if you've dabbled in real estate, is everything's pitched as a passive investment. But the reality is that so little of real estate is truly passive. And the amount of hours that I spend on the active management side is significant. So with that, about 2020, I started and kind of like Stephen found that syndication aspect of real estate where you truly can be a passive investor in an opportunity. So since then, I've invested personally in multiple different syndications, multifamilies, this fund last year, again, this fund this year. But I launched Rogers Capital about 2 years ago. And really, the whole mission of Rogers Capital for me is to provide education for investors around real estate investments. I truly think it's one of the best. I've completely shifted my investment strategy. It's been great to be a part of, and I'm super passionate about financial literacy in general. But with that, I'll pass it back over to Steven. I'll keep admitting people, but so far we have everybody in. And Steve, actually, do you want to give your brief intro?
Yeah, first and foremost, thank you guys for supporting us, partnering with us, and taking this crazy journey that we're taking in this space. But I'm Steve. I'm one of the CEO. I am the CEO and co-founder over at Techvestor. As Stephen and Danny have shared, we're kind of one of the crazy ones to go do short-term rentals at scale and find a way to make it work. And well, it's been working here for a few years, going well. But one thing we want to really echo is making this asset class really accessible to folks, right? Getting into Airbnbs and short-term rentals as an asset class is a really hard thing to do. And I think Danny echoes how hard active management can be, especially when, this is a business wrapped around real estate, not just a real estate that does its thing. The cash flow is great. Those types of things can be fantastic, but it definitely takes a lot of work. So a little bit of background on myself, ex-tech, 5 years at Facebook, built teams, scaled a lot of organizations. And if there's one thing I can tell you about what we do really well, it starts with our team. And you'll get to hear a little bit more about them later today. They're fantastic. We come from this industry. We come from both real estate, technology, and kind of bridging that gap. So I'm excited to walk you guys through a little bit about what we're up to today.
Cool. And essentially the structure here. So Danny and I structured a joint fund at the onset of the year with the goal of, obviously, we write a significantly larger check. You get significantly better terms than retail, and everyone wins. So, a big thanks to Steve for, I'd say, generous terms or letting us beat him down, however you want to phrase it. So
it goes both ways.
However, maybe in your shortest words possible, how do you summarize kind of what the big idea is here, Steve?
Yep. So we buy single families across the country, right? Turn them into really high performing short-term rentals, which you'll see a few photos here later. We find them, design them, renovate them, operate them, and hold them for as long as needed while we cash flow along the way. We'll eventually disposition, package them up, sell them off to a large institutional partner who wants to buy what we're doing, but they don't want to build it because it's too much work, right? All those big fancy private equity firms that I won't mention here, they love what we're doing. They love real estate as itself. They love cash flow that comes from it. They love yield, but they can't go buy one property, one brick at a time, right? So the value we're doing, that sweat equity, that's what we're going to get rewarded for here over the course of the next 4, 5, 6, 7 years.
Sure. Makes sense. So Danny, in terms of the way we've structured our fund distributions and everything, can you kind of walk through it, the opportunity?
Yeah, absolutely. So I think there's really two parties that we serve primarily, one being the investor, and of course, one being the end consumer. This slide really looks at how we serve the investor. So like we said, syndications are one where as a limited partner, you do have 100% passive investment in the opportunity. There's no decision-making on your part. Cash flow is paid out quarterly after the first 6 months. There's no asset under management fees. As a limited partner, you maintain 100% of your tax benefits pro rata to your investment. You immediately have diversification in over 100 properties across the country. Last year, we managed Fund 1. Fund 2 is already outperforming where Fund 1 was last year. And this is a huge piece that really can't go underspoken, but as an LP, you have zero liability on loans and lending. That's something very different from being an active investor. And, we have conversations with people who are writing these larger checks, that's $500,000 to $1 million. But we also have people who are starting, and this is their first opportunity into a real estate investment. So you can get started for as little as $50,000. And we have a little bit of flexibility due to the large check size that we're writing Techvestor in total. So we really want to work with everyone. As we switch to the next slide, I think the second group of people that we serve is families and the end consumers, whether they're business travelers, groups of friends. And, Steve, handing it over to you, one of my favorite stories is the whiteboard story. Do you mind sharing that with everybody?
Yeah, so I can't remember exactly when this was, but it was one of our first properties that we ever launched. It was actually in Scottsdale, and our Scottsdale homes very much look and feel like resorts. And we had a little girl take a photo about what she with her grandpa, and she posted it to the whiteboard. And next to it, she said, "Thank you so much for allowing me to have a really great time." Right. And from the photo, you could generally see that the grandpa wasn't probably in the best shape. It seemed like they had come together, right, and traveled to this location. And we got this photo of the photo from our cleaner. And when we went back and even looked at the data, because yes, we collect a ton of data, we realized that we serve larger groups. We serve families first, right? And even the ways we were amenitizing our homes, the memories we were providing, the experiences we were crafting, it's not just an investment, right? And I think so oftentimes investments feel better when the end consumer is also rewarded. So that was a really great feel good moment for us as a company.
Yeah, that's awesome. And it's funny, I actually had an investor join last round, and he sent me an Instagram picture from one of his friends from high school that he hasn't talked to in like over 5 years. And it was this bachelorette party that was all enjoying the pool in Scottsdale. And it was like, dude, this is the investment we just got into. And I think that's one of the biggest things, right? Like, this is fun. Short-term rentals are fun. They create experiences. The market and what people desire is all about the experience now. So then kind of ending, as we move into what the exit looks like, we've obviously had multiple conversations on what that could be. You've talked to multiple different potential buyers that are already interested because they do understand how much work goes into this and they have no desire to build it. And of course, we're crushing the metrics, which we'll get into later, but walk us through what does the exit look like? What are the possibilities?
Yeah, I think as someone once told me, it's one of those private equity firms that has a color and a rock, right? Might come through and say, "Hey, like we really want to buy this." And in speaking to larger institutions, the thesis, like I said, has always been the same. It's we don't really have an interest in building this because they don't really have the time, energy, resources, or want to spend the ability and distributed capital efforts, right? You're talking about institutions who got to drop $100 million a week, right, to make things interesting, or oftentimes a day. And the ability for us to do all this grunt work is very much like if you're familiar with multifamily or apartment building investing, what we're doing is the value add component of a portfolio, right? We're doing something, bringing it to a level of stabilization. And whether it's an institutional exit or a retail exit, which we had 8 exits in our first fund already, and those kind of just flew off the shelf, right? We tested that as a theory. And so I think we're going to have some really great options here as we pursue that outcome. And the great thing here, people always ask, is what happens if you can't sell? Because we're doing something that's never really been done before, right? That's the reality. No one's tried to scale a short-term rental portfolio to this level of scale. And the reality is we have a great cash flowing asset on our hands with fixed rate debt. No one's going to force us to sell, right? Worst case, we continue to hold for a little bit longer, cash flow a little bit longer. And I haven't heard many people tell me that a little cash flow didn't hurt too often, right? So I think we can navigate the world as it comes.
Yeah, and you touched on this, Seif, before, but the underwriting that Techvestor's done is extremely conservative. Do you mind we already touched on it a little bit. What are the cap rates that we underwrote all the exits at, and what did we sell at, and what have you seen STRs selling for?
Yeah, so we sold our 8 between a 5.5 and a 6.5 cap on exits. At the time, interest rates were fluctuating between about a 6.5 and a 7.5. And we underwrite for roughly about a 7 cap on exit, but these were exits that we had on an individual basis, right? So typically how it works with portfolios at scale is you get this thing called cap rate compression, right? The more units you have, the harder it is to replicate. The more cash flow you have, the more efficiencies you have within that portfolio. It's the same reason why apartment buildings sell for larger multiples, right? It's the same reason if you roll up 15 medical offices, they sell for a larger multiple because you get efficiencies within that infrastructure. And all our properties are generally distributed, but we have enough density in our geographical locations of choice where you do have those operational efficiencies, right? So they have shared resources, and all these types of things allow us to, generally sell for a larger multiple than if you were to sell off an individual home. So these are things that we're certainly looking forward to. And, I think so far we're doing a fantastic job on asset management. Revenue's been really fantastic. We've sent out over $2 million in cash to investors over the last couple of years. We'll cross $2.5 million here by end of month for sure. So we're really excited about that.
Yeah, agreed. And you hit on the exits here already, right? But before we talk about Fund 2, I did want to pull this up because I think, one, Danny and I were quite involved in Fund 1. But I think it goes without saying that raising 37 million in the first go at this and acquiring 80 properties is no small feat. And what you just alluded to, Steve, I'm pretty sure Yahoo Finance just did a piece on this, on how quickly we scaled up that cash flow distribution and really beat projections there. So for those on the call right now who are either investor of mine or already involved in fund two, as we kind of gear up for that side of the house, it's going to be really fun as well, right? We want to get cash back in your pockets quick, and looks like we'll be doing that. So as I shift over to some metrics on both funds, I just want to give a bit of a recap. Looking at 1 and 2, we're in aggregate now 10 plus markets, 120 properties. We've got hundreds of investors now and over 3,000 reviews on Airbnb, et cetera. So at the end of the day, like, we are certainly on the map. The performance has been visible. And, I think this really only scratches the surface with the level of transparency that, Seif and quite candidly, you and the Techvestor team provide. But maybe you could dig in to this a bit more granularly on the performance front.
Yeah, certainly. So what you're looking at here is what many investors have told us looks like a short-term rental ETF. So we can't use those terms legally, but we joke about it because it's exactly what this is. It's a diversified portfolio of properties. Each column is the month. Each row is a property. And like any good ETF or a normalized ETF, you have months that you do really well, and you have months where you lose a little bit of money, right? But on a blended basis, we're trending towards about a 9.6% annualized cash on cash. I cannot stress the importance and value that our team brings. Our head of asset management comes from Vacasa, right, which is one of the largest, if not the largest, short-term rental property manager in the country, and one of the only ones to ever go public. Our head of data is fantastic. Our head of revenue is fantastic. We have significant operational advantages on the ground, led by our head of operational infrastructure. All these people contribute to what we call, right, asset management of this asset class, because it is a business first and real estate second. So, as you kind of look at these, obviously some of these properties have seasonality a little bit more than others. And that's another great value that we get in a portfolio. You get that seasonality diversification, whether it's, people think of seasonality as winter, fall, spring, summer, et cetera. We think of seasonality as events, micro seasonality, by the week, by the weekend, weekdays, and that's how we're able to command certain pricing. We'll get into that in a little bit when we talk about revenue and pricing, how we do against others. But you can even see the seasonality matrix down here below. So we're really heavy between February and August, but we're not dead in the other months, right? And so, in short-term rentals, you're not getting the same distribution every single quarter. That's just not how it works. You have peaks and you have valleys, but the value of doing a diversified portfolio is, we buy in Scottsdale, for example, which is, high season is January, February, March, April, et cetera, but then it's really hot in the summer. So we also have summer destinations in our portfolio that balance that out. So this is a really good snapshot of kind of what to expect on an annualized basis. And I actually think this is just the beginning. I think we have a pretty strong shot here at 11, 12, 13% cash on cash with, a few optimizations and stabilization, even just with inflation over the next year or two.
Yeah, and the level of transparency here is significant, right? I mean, obviously performance metrics like that don't go unnoticed. We already talked about the $2 million in cash distributions to investors, but what's your favorite press appearance to this point? I feel like every time I look at LinkedIn, there's another podcast or another, large business article.
I think one of the ones that kind of took us by storm a little bit was, the Yahoo Finance one that you mentioned, right? $2 million in just as many years. And when we have to remember, we're not a venture-backed startup, right? We built this from brick by brick. We don't have any outside investors. We don't have to do anything other than deliver returns to our investors, right? There is no other ulterior motive in selling the company or doing those things. And as someone who got into the space because I was looking for passive income myself, I'm a user of my own product type of thing. And knowing the team that's behind it, putting $2 million plus in people's pockets is meaningful, especially during times of, as some people may see it, as uncertainty or tougher times or thoughts of a recession. And, I think we're trying to set the status quo that there is success in real estate these days. You just got to look a little bit deeper.
Of course. And, as a direct result, this has attracted a lot of talent, right? So Steven and I both mentioned Sam Silverman. Obviously, he's come on board now as a GP with Techvestor, but tell us about the team you put together.
Yeah, I mean, look, you have everyone from Josh who, was previously with DR Horton, one of the largest single family tract builders in the space. We have an incredibly strong operational arm on the ground. It's probably one of our secret advantages to how we're able to unlock the ability to kind of, how do we do this is a question we get all the time. How is this supposed to scale? You have folks, I'm ex Facebook, Sabrina's ex Apple, bringing the worlds of technology right into the place. Even our advisors come from places like AirDNA, right, is one of the largest, if not the largest, short-term rental data analytics firm in the space. And we have a few other advisors that are likely going to join our advisory board. We're in the final stage of finalizing that, but these are folks who have, really been in this industry for, decades, if not longer, and have scaled not just portfolios, but companies to billions and billions of dollars. So I think a lot of folks in this space and are joining not only our team, but are joining our bench. And I think having that bench as being this industry's infancy, I think is going to really lead to a really positive outcome.
Yeah, I mean, what you've put together, quite honestly, is, I mean, it's impressive and it's really incredible the short period of time. So why STRs? I mean, why capitalize on this asset class?
Yeah, I think for us, we were users first, right? When I was at Facebook, I spent 5 years building teams and infrastructure, and part of my job was to recruit people to Facebook insert city here, right? Boston, New York, wherever it was. And, when you're talking to that family in Dayton, Ohio, who's, a family of four, see the Facebook brand name, see the benefits, see the compensation, it's like an easy decision, right? The question wasn't, the company or the compensation. It was, what's my family going to do there? What's life going to look like? And so part of the experience was, let me live in each of these cities for a week in a different single family house and see what the experience was like. And I used Airbnb to do so. And when you'd walk in and actually stay in these properties, the properties were pretty poorly done, pretty done, dungy looking, and just, it wasn't really hospitable and really in any way, and didn't make you want to come back. And I asked myself why this was happening. I'd eventually meet Sabrina, and she was showing me how much her Airbnbs could make and how she was running them. And I was like, no, you don't understand. Like, this is not my experience. And of course, everyone's had that poor Airbnb experience. And I would move over back to hotels. But then as I would continue to become a father and travel with groups, hotels just weren't the right option, right? And so we asked ourselves, how can we scale this asset class? We built software around this asset class, and demand was pretty high. So all those things led us to kind of where we are today. But also when you look at the data, Airbnb has one of the largest footprints in terms of global mobility, right? It's a $150 billion global business that's only growing, half of which happens here in the US. And even more so post-pandemic, right? Demand pacing is up, meaning people are not only moving around more often, they're planning to move around more often, right? Which is a psychological shift in behavior. The number of bookings, the number of nights, and the best thing that I love about this industry are 3 words. It's mom and pop. And while I very much love and respect mom and pop investors, it offers the opportunity to invest in a fragmented space for the right operator and the right team with the right technology to come in and execute a well-defined plan. And that's, I think, exactly what we're trying to do.
Yeah, that's exactly it.
I'll hit on that here in a second. Danny, real quick check. Do you want to see if there's anyone in the waiting room?
Yeah, we're good. Everybody's logged in.
Cool. So I think, I get asked this question all the time, and to that point, Steve, why can't I just go do this myself? And the answer is that you can, but it's extremely difficult on your own or even as a small shop. So in 2 years of looking at the competition, primarily mom and pops or do-it-yourself operators, like, what have we learned there about the competition?
So before I even describe what's on screen right now, I want to share a tweet that I actually read. I think it was earlier this week. One of the larger data analytics firms did a study or asked their users some questions. They asked how many hours did it take to stand up your Airbnb, and how many hours do you spend per week operating it? The numbers would stifle you. 70 hours per week to stand it up and 7 hours per week to operate it. Now, granted, are they operating it efficiently? Probably not, right? But those numbers were like eye-opening, and that's exactly the type of thing that we compete against, is the mom and pop owner, right? The person who's got a W-2 job, many of us on the screen today, but this isn't your strength, right? Your strength isn't running and operating, finding the right property, operating it with great revenue, with great operational X management. What design are you going to put, digging into the data, building those efficiencies, attracting the right, you can't attract capital because you got 1 or 2 properties, right? You don't have an infrastructure large enough to actually drive this effective change. And I think in this space, Airbnb and, short-term rentals as a whole, it's a pre-institutionalized asset. where, this is our competition. In fact, many people tell me this looks like a dorm room. And that's the reality, right? This looks like a dorm room, unless you want to stay in a dorm room. Most people don't these days. But we also focus on these larger experiential homes that have incredible amenities. And you're about to see some of those photos here, right? Like, mini golf and golf simulators and pickleball courts and fire pits and basketball courts and pools and cornhole, giant Jenga, incredibly well designed, well thought out spaces. And when you might ask yourself, well, can't anyone do this? And the short answer is you can try, but you need a lot of money to do so, especially if you're going to do it yourself. And more importantly, you need to be able to operate them well. It's not about standing up the product exclusively. In fact, you got to be able to execute the vision, execute the revenue management strategy. And I think those are things that we excel in, day in and day out.
Yeah. I would agree. And I'll point out this whole portfolio is available on Airbnb and in the data room, which I'll drop later for review. So please do go check them out, poke around. You can even do like a 3D tour. They're experiential, right? I think this goes back to data. Data matters, design matters, and data powers our design, which is absolutely a unique value add, right? Like this piece of the puzzle can't be overlooked in just creating an actual experience that someone remembers. So I'll breeze through this because I think we've harped on it enough, but we have slides for the kids and golf simulators and these things that really stand out in people's minds and genuinely drive more revenue. In fact, this I think it's our pink Barbie house, I believe. Correct me if I'm wrong. Was this just hosted on TV, Steve, on Staycation?
Yeah, this was just featured on Staycation. We launched it actually well before the Barbie movie came out. So, right time, right place. And we definitely saw a pickup here. But this is a property that I believe, off the top of my head in its first year hit a double-digit cash on cash, right? And when people think about what success looks like in investing, and you're asking me when I think about passive income and investing for cash flow, I think about double-digit cash on cash as being really meaningful towards my life, right? And this was definitely a year-one success, and we hope that'll continue.
Yeah. I've got hundreds of photos like these. We won't keep harping down, but it's clear how unique some of these properties are and why they're so memorable, right? And why we get the reviews we do. So while we've been performing incredibly well, this hasn't necessarily been the case across the entire STR market, right? Even when we look at the other big players. So when we look at performance through third-party data like AirDNA, like how are we stacking up right now to the big guys like Vacasa or someone, right? And maybe what's going on in the market that's causing some of that turbulence?
Definitely, right? So when you look at the marketplace and you see some of these headlines, which we'll get to here in a bit, but you see the words Airbnb Boston, I can't get my place booked, and occupancy and revenue is down. And I think the first thing you got to ask yourself is, where is the data coming from? And what you're looking at here is data from one of the largest short-term data analysts from the space, AirDNA. We're crushing, Vacasa by 56% when it comes to revenue, right? And here's the thing, it's not necessarily Vacasa's fault. Right. In this industry, we believe one of the problems is the relationship between the owner and the property manager. Right. So Vacasa can only do as much as what they're handed to from an owner who may not necessarily have bought in the right property, designed it in the right way, kept it up and maintained it. So with us, we're vertically integrated. We do everything end to end, which allows us to drive the performance that you're seeing on screen. It allows us to reduce our ongoing capital expenses. It allows us to host tens of thousands of guests. It allows us to make decisions in real time, from acquisition to who we hire, to how we operate, to how we design, right? And all these things go through a 16-point checklist that allow us to understand what to do, when to do it. I can't stress how much data we collect on a day in and day out basis. Every decision is made with logic. The industry is used to being made decisions based on emotion. And if you ask me, in the investment world, oftentimes data will always outwin in a logic versus emotional type outcome.
Now, see, if we skip past it, but looking at Superhost Labs and really talking about how we compete against people like Vacasa, obviously Superhost Labs wasn't the initial plan. We didn't plan on going entirely fully vertically integrated, but that's where we are today. So tell us how you made that decision to build that team out.
Yeah, I mean, this was Q4 of 2021. We had just raised our first $7 million in 30 days, right? It was, we were coming off a high, thinking product market fit, everything was perfect. And, we were going to hire other service providers to do the renovations, the property management, the things that we didn't want to do. We wanted to be this tech forward company that, you know, could scale real easily. And we were quickly disappointed. The market changed, right? Companies started laying people off and resources weren't available. And we were here stuck with dozens of properties. And how are we going to find and operate them and design them and renovate them? So we built our own operating infrastructure, which is Superhost Labs. We trademarked STRs. We call it the short-term rental operating system, everything from how we acquire to design to operate. And in retrospect, I don't think we could have done it in any other way, right? I think this is one of our biggest competitive advantages today, that we control the entire spectrum. But this even goes to show you how quickly things can change and what kind of team we have here that can pull this off, right? Overnight, I remember the day like it was yesterday. It was December 30th or the 31st of 2021. And we're sitting there and we're like, shit, what are we going to do? Right. And this is the reality of investing in real estate and investing in anything just in general, right? Is, you know, anyone, you can read these stories about fantastic outcomes, but let's talk about the journey to get there. And if you're going to invest with anyone, right, you want leaders in place, you want talent in place who can navigate the problems that will come up. Because I assure you, no business goes to plan, and ours didn't either, right? And so if that's something that is meaningful to you, I think you'll find that we have a really great leadership team to go out and pull that off.
Yeah, so in the next slide, Steven's going to touch a little bit on how the acquisition process is different and how you brought data in. But just looking at this map across the country, you know, what have been our most successful markets so far? What are the markets that we're launching into as we close out 2023, and what's on the horizon?
Yeah, I mean, so look, we're in 10 plus markets today. You know, with certain levels of density. We're in places like the Poconos in Pennsylvania, which many of you may not even be aware of as even a place on Earth. But a lot of the East Coast actually does. And those are the types of tier 2 markets that we look for. We're in places like Scottsdale, Arizona, Clearwater, Florida, Panama City Beach, in Florida, Memphis, Tennessee, Blue Ridge, Georgia, Branson, Missouri, Galena, Illinois, McGaheysville, Virginia, right? We're looking also into the outskirts of Asheville, North Carolina as an intriguing market where we have some interest right now. And what you see to the left here is generally our typical buy box, right? We are buying middle of the road, you know, typically larger homes, 4+ bedrooms with enough space to amenitize it with pools and games and those types of things, driving a 20% plus price to rent ratio, which is kind of something that we look for, and driving really great growth. We are fantastic operators, and that's what we do. It's real easy to drive $200,000 in revenue if you're buying a $2.5 million property. It's that luxury type feel. Now go drive $200,000 in revenue on an $800,000 property. That's what we do, and that's what we do well, getting those outsized returns.
Yeah, and I think, you know, Steve, you and I both come from a tech background, so we understand that there are ways to optimize this, leveraging technology, and maybe you could speak a little bit to the software component here on the acquisition discovery.
Yeah, so when we first started, we actually built our own software for ourselves because I was looking to buy 8 Airbnbs with Sabrina. That was the initial, how do we build software? Because back in 2021, every piece of real estate was flying off the shelf, if people can remember those days, right? Like if you didn't know about the deal before it hit the market, you were already too late. Highest and best, all cash offer, all these types of things. So we built software so we can underwrite properties faster. And you know, what we learned is about 96% of properties don't even work financially, just on a straight numbers basis. And then we shortly positioned that over into a managed service, which then eventually led into our fund structure. But what you see here is our softwares and our technology and our inputs and our portfolio composition and planning and our people allow us to understand what to buy, where to buy it, understanding these top line numbers. Is it in a regulatory zone or not? We're market mapping 257 local markets at any given time, right? To better understand and collect not only supply and demand short-term rental data, but physical real estate data to understand, can we buy 20 in this market? It's not about buying one. Can we buy 20, right? Because I want density. I want efficiencies. I want the ability to hire labor and spread that cost out over a number of properties so we can drive that outsized performance, so we can move the needle, right? These are the things that we're thinking about, and we build software and technology and leverage a ton of data to make these decisions on a day in and day out basis.
Right. And, you know, we already touched on kind of the 16-point strategy, but I laugh looking back at a few of these metrics, like the 200 plus ADRs, and we're smashing that right at 400 plus. So there's a lot of the strategy that I think we've been able to optimize, but I do want to keep the pace here. You know, for those who may have joined part of the way through, our current fund is taking on investors in 2 final rounds, right? So for Fund 2, we'll be raising through October 15th and then again through December 1st. The kind of quick and easy on the numbers here, 50K minimum. Again, we project a 4 to 5 year hold, which we're almost a year into. We pass along the tax benefits to you, and you get a quarterly distribution direct to your bank account. So the way that shakes down is, we're creeping up on a 12% cash on cash yield, and annualize them with the velocity of compounded growth, that's over 18%, right? So really strong investment profile. We're not taking an AUM fee, and we give you some flexibility into how you actually invest that, whether it's a trust entity, et cetera. So maybe Danny, do you want to share a little bit on kind of our split structure here?
Yeah, absolutely. So this really is where Steven and I have partnered directly with Techvestor and negotiate the best possible deal for our investors. So for those of you who are new to real estate syndications, I'm just going to give a brief overview as we look at the numbers. We're offering a 9% preferred return, which basically means the first 9% of all profit goes to you as an investor. After the 9%, it then goes to a GPLP split and waterfall, which is 65-35. So as an investor, you maintain 65% of every dollar after that first 9%. And, I'm someone, when I think about the big picture, I really think about incentives. And the reason I love real estate investing is that as a GP, Techvestor, Seif, Sabrina, all the co-founders, no one's making money until after the investors made the first 9%. And then after, they only get 35 cents of every dollar after that. So the upside potential for this as an investor, everybody's aligned from an incentive aspect. The GPs, all the founders want this to perform at its max potential, which of course delivers an even better return for you. Seif, is there anything you want to add here before we flip to the next slide?
Yeah, I think the biggest thing I would add here is how great these terms are, right? One of the reasons Steven and Danny can offer these fantastic terms is because of that group level investing, right? And I can't reiterate how awesome it is that the world allows us to do this. So if you're someone who's considered investing in this asset class, thinks that this is interesting, this is a really great offer, right? In terms of the split that you're getting between them and between us. And I think we're excited for the journey to come, but I mean, having a 9% pref is can't really find that these days.
Yeah. And I want to get into the meat. There's a few things on risk mitigation I want to hit on. So maybe quickly touch on this, Danny, and then let's jump into that side, right?
Yeah, we want to leave time for questions. So let's just focus on the center of the screen here, basically visualizing a $100,000 investment. What does this look like for you as an investor? The first 2 years, that's when we are acquiring the property. We're doing all the renovations, the design, and stabilizing. So you'll notice cash flow in the first 2 years is lower. What we found in Fund 1 is that we're already outperforming Fund 1 metrics. Fund 2 is outperforming Fund 1, and the upside potential is significant when you look at that GPLP split. But distributions are paid out quarterly. It's just you're taking this annual return divided by 4. And first distribution goes out after your 6-month mark. And then, of course, a large piece of the investment comes at the end at some point of exit. We've touched on that, but the big picture is we are going to exit at 5 years is the goal. So it's a 5-year hold target. And then, Steven, do you want to touch on the larger investors?
Yeah, I know we're talking to a few people, looking at $250,000, $500,000 checks. There's obviously there is variance in that split opportunity at a larger check size. So I would point that out as well, right? Now, all of that said and done, again, we'll make this available to everyone for some of the minutia of the numbers there. But for those who are excited at this point, I'm sure one of your burning questions, is what are the risks? How can I kind of protect the downside? So, Seif, what can you share about our acquisition, finance, and lending strategy and how we've maybe turned some of that risk mitigation into an advantage?
Yeah, I actually think this is probably one of my favorite parts of our own investment, is the way we're able to hedge fairly well. So first and foremost, we're buying responsibly. We're buying the right product based on data, right? And that in itself is oftentimes the first rule of real estate is buy well. Not only are we buying well on the asset itself, but financially we're buying it well. We're typically putting about 25% down, call it about 75 LTV. And then we're putting in about $125,000 to $175,000 in renovations, fixings, furniture, bringing that property up to what I like to call a modern world. And that post ARV status of the value of that property is giving us another 5, 10, 15% of equity right? So you're really sitting at about 30 to 40% of equity in that house. That's an area where we feel very comfortable in, right? All of our debt, in addition to that, is going to be fixed for a minimum of 10 years. And I can't stress how valuable this is. If you go back to '08 or really any crash in the history of the world, the people who lost their shirt had what's called floating rate debt. These are people who unfortunately had debt come due at a time when, well, it was unfortunate in the world. And the reason that that happened is they likely took out what's known as variable rate debt, or also known as floating rate debt. For us, all of our debt is fixed. No one can call it due. No one can say, hey, you owe me money. No one can change the rate on us for a minimum of the next 10 years. Now, in Fund 2, about 75 or 80% is actually 30 plus year debt, right? So not only is it not going to happen for 10 years, but on most of our homes, which are non-cross collateralized, it's not going to happen for 30 years. What I mean by the non-cross collateralized is each home is its own independent loan. So if for whatever reason something happened, right, like God forbid, it'll feel like losing a pinky, not losing your head, right? And that's the analogy I like to give. And you live to fight another day. And that right there is a part of our asset management strategy, right? Is to drive great revenue to great assets and manage and operate them well. And what you see on screen is a term called DSCR. DSCR stands for debt service coverage ratio, meaning currently today, we're driving around 3 times the net operating income. Net operating income is after expenses versus the cost of our debt. So if our mortgage payment is $33,000 for the year, we're driving $99,000 in net operating income, which is a really healthy ratio. If you compare that to, say, multifamily, they're typically looking for a 1 to a 1.5. And, the closer you get to 1.25, 1.5, it's going to be, they'll look at it as really, really healthy. So we're going to be 2 to 3x that really on an any day basis.
Excellent. I want to kind of buzz through. I know that there's yes, Seif does need to light up his face a bit. You look like a dark silhouette. We'll get to some questions here, but I'll just take this and actually I want to breeze through it. Essentially we're forwarding the bonus depreciation. So everything that we're able to build in from a cost seg analysis, basically maximizing depreciation tax benefits, is flowed down to the investor. So on a 100K investment, that might look like, $35,000, $40,000 of passive losses that can be put towards other losses there, right? So there's certainly a tax advantage. I can see at least one CPA on the call, including mine. I am not a CPA or a financial advisor, so ask your advisor on how to do that specifically, but there is an advantage there. And I'd mentioned this as well, I guess, just, outside of the advantages on the tax front, we do create this kind of secondary advantage pool, which is a bit unique in that you can stay in any of our properties. It does not harm the fund in terms of our actual, take home, because at the end of the day, we're just cutting out the middleman in Airbnb and VRBO. So email our concierge. I know Danny's had friends stay in these properties. I've got family staying in these properties soon. But having utility is quite unique in a passive investment. So it's not something you get with a debt fund, RV fund, ATM fund, multifamily, et cetera, right? Like you're literally can enjoy these yourself. And I think that creates a bit of a more fun investor experience. Apologies for picking up the pace, but I want to leave time for questions. Hopefully by now we've got a lot of the audience excited. For some of you, maybe not, and that's fine too. I think our first priority is always going to be, making sure an investment is appropriate for you, right? Like Danny and I both run real estate investment firms. We'll have other projects. So if this isn't the one, we'll probably have something that aligns to your needs down the line. But for those on the fence, please take us up on a one-to-one meeting. For those who are ready to make the jump, here's kind of what you need to know, right? We make it really easy. We send you the PPM, standard paperwork. You send us the wire. Once that hits the account, we verify accreditation, and then you're done, right? And we scale that portfolio up, and you can expect in roughly 6 months to start seeing cash distributions direct to your bank account. So those are the steps. Like we mentioned, we're taking it on investors through December 15th, and then, sorry, I keep saying that, October 15th, and then December 1st. So 2 more rounds in Fund 2, although we'll almost certainly be raising another fund next year. And I just want to point out, we don't disappear after that, right? We've got some current LPs on the call of mine who can surely attest to this, that I'm constantly putting out updates, if not too many. But we use a platform called InvestNext, where you can easily track distributions and performance. as well as kind of gain access on, future projects. So when we do, when Danny and I launch multifamily and debt funds and things like that, you've got first subscriber advantage, which is important. So with all that said, before we open it up to questions, I just want to say a huge thank you to those who did attend. We will send this recording out. Steve, it's always a pleasure to work with you, and thanks for joining us today. And Danny and I have had so much fun in this fund, so we hope everybody does stick around. We've got our contact info over here, and I'll probably drop some other details in the chat as we're talking through. But without further ado, I want to move over to some questions from the audience. And Walt, you dropped a few here in the chat, so maybe did we answer your question on the K1 filings? And do you want to ask anything else when it comes to like physically who's looking at the acquisition side? Or do we still have Walt?
Yeah, I mean, really quick, while we're seeing if he's on from a K1 filing aspect.
I'm here. I didn't have the audio on.
Okay.
The questions I asked in the chat have not been answered.
Got it. So looking at the first
what
one,
states do we operate in? So K1 recipients, Steve, what does that look like filing state tax returns in different states?
Yep. So most states do require us to file on the state side specific for investors. And so we'll provide all those documents, and then you will need to elect a tax filing in that state if required. None of this obviously is tax advice. If and where we can do a consolidated K1, we do, right? And so those are things to make it easier. We have to file the same sort of painful taxes you do. So we totally get it. But we're going to try to keep that as simple for you as possible. And I think generally speaking, we typically expect most portfolios to be in somewhere between 4 and 6 markets, right? And when I say markets, I don't necessarily mean states. I mean 4 to 6 different markets. For example, in Florida, we might be in West Palm Beach and Clearwater. Those would both be in the state of Florida, but would be in completely different parts of Florida. So I think you can generally expect, markets to be in that range.
Yep. And then do you want to talk a little bit about like physically doing some of the acquisition discovery and going on site?
Yep. So we're a fairly well-distributed team. So a couple things. Sabrina, who's one of our general partners and co-founder, she lives in Scottsdale, right? So if you ever need to get physical eyes, we're there. We have market managers on our payroll in our markets. Think of these as general managers, like Uber has, right, for certain locations, especially in our core markets. We also leverage technology fairly well. Some of you may be familiar with a tool called Matterport. Matterport is really fantastic 3D technology that you can, someone goes and they can scan the whole house and you can walk it as if you're there. In fact, I think an example of that probably is in the data room that you guys can check out of a property that we've done. We also have inspection reports, multi-checks on those. So we're typically buying very well. Not only are our title companies clearing these, so our appraisal company, so is our lender, so is our general contractor, head of operations in-house. Right, these are all multi-step checks to actually do that.
Cool. I want to pass it over to anyone else who has a question, and then we can come back to you, Walt. But I want to make sure we get to everybody.
I agree with Walt. I need a camera. I need a light. My bulb went out, so I apologize. I have a light right here, but it went out.
So when we look at property density, then see if what is the tipping point at which boots on the ground it is essential?
Yeah, that's a great question. And there's 2 ways we look at it. So it's either going to be by unit count or by revenue, right? Because you can have 6 properties in a market where there may be smaller units and do 600 grand in revenue, or you can have 3 units each doing $200,000 and you have the same amount of revenue that's at risk or at management in that market. And so what we find typically is it starts to make a lot of sense around that 10, 11, 12, 15 number, right? And there's at least 3 markets where we have that density. There's a 4th market right now over in Memphis where we're approaching that 8, 9, 10. And it's starting to, we're starting to ask those questions, like, is it time to, build that person in? It also just depends on what your operational expense ratios look like and what challenges you have in that market look like, right? So challenges you have in the Poconos are very different than what you have in Scottsdale in terms of terrain, type of avatar, type of guest, the size of home, what type of amenities. And if it makes sense, we'll certainly add it. But all these things are actually led by Andrew, who's on our team. He's our head of operational infrastructure. They all roll up to him, and you should see the amount of data he tracks. These are things where it's very obvious where we should add a human resource there, even if it's like for service calls that we can bring in house, to drive those costs down. I think we have a great opportunity to drive expenses over the long term.
Any other questions? People can either raise hands in the chat or just come off mute. Either way.
Yeah, I got a really quick one. If you guys can hear me all right, I'm out on the go, so it may not be super easy to hear me.
Yeah, we got you.
But cool. Yeah, thanks, Danny. But yeah, I think the model of how Techvestor has grown is really cool. And it's nice that you guys have been able to kind of do that bootstrapped in almost a way. But I'd be curious, what's your guys' burn as Techvestor monthly?
Yep. So we're fully self-sustainable and profitable, right? So we run our operating company and you're investing in the propco, right? So our opco is designed to be a little bit profitable, right? And actually turn a profit. And you want that, right? One of the worst things you can have in this industry is a real estate operation that is burning too much cash and losing money, because at that point, your assets are at risk. The equity is at risk, right? And so our opco is built in a sense to really sustain itself, and is not hyper dependent on any other third party revenue streams and those types of things. And the good news is, as we continue to scale and launch, our capital burn is marginal, right? You don't need 16 heads of management for 16 funds, right? You need one or two, right? So actually, as the foundation has grown over time, our burn has actually become less and less of a concern, right? If this was day one, we've never raised $1. These are things where, Sabrina and I back in the day definitely would have funded things out of pocket for a little bit longer, right? But we've been profitable since day one. And, we fully expect that to continue and self-sustain.
Yeah. And I like the idea that it becomes more efficient over time as well. So that makes sense.
Each fund benefits from each one another, right? Especially as we scale.
Yeah, it almost compounds on itself. Well, really cool. That answers my question. Thank you.
And Steve, while we're waiting on other questions, talk about where we're at from a pro forma standpoint on Fund 1 and how we're comparing to the metrics and maybe the impact that could have long-term for an investor.
Yeah, so Fund 1 right now is trending around that 9.6, 9.7% cash on cash number. When you look at revenue in itself, we've really crushed that very well. And I think we've underestimated how well we can do on revenue. I also think we underestimated how expensive things can be in the last 24 months with inflation and those types of things. So where we have our biggest opportunity today is going to be able to drive down expenses, right? I think revenue will continue to pick up and continue to pace. We're seeing what we call same store revenue in terms of same store properties year over year grow on a double-digit annual basis for the most part across most properties, which is fantastic. But our biggest objective in the short term is how do we optimize those expenses? Because that's really how you unlock cash on cash. In fact, internally, we call this a rubber band, right? And I know this sounds really obvious, but if you pull a rubber band from two ends, you can actually stretch it much further than you can stretch it from one end, right? So you have one person who's driving a lot of revenue, one person who's driving expenses down, and it becomes a beautiful marriage over time. So I think those are things that we're very excited about. I think things that concern us over a longer period of time, of course, is the cost of debt. And I think it's naturally, cost of debt impacts and hurts everybody, right? It's inefficient capital markets. The good news for us is we have a higher than average cash flow yield, which allows us to really never be in a position of negative leverage, right? And those are things that, when rates come down, we can refinance. In fact, someone asked me the other day, they said, "Are you concerned about interest rates?" And I said, in the short term, maybe, but in the long term, hell no. And they were very, adamant of understanding why. And the reason is I'd much rather be on the side of hoarding assets today and refinancing later than the opposite, right? I firmly believe that assets will be worth significantly more in the future because I believe where we are today is you're either going to have to print more money or drop rates fast enough. And either way, the benefactor is going to be the person who already owns the asset, right? So I'd very much rather be in that capacity.
Yeah, before we move off the topic of rates, then when we look at the average fixed interest rate in Fund 1, looks like Walt's curious on kind of the rate in the last 5 purchases. Can you speak to that?
Yeah, I think you're seeing anywhere between a 7.5 and an 8 right now, which is going to be what you're getting on the retail side. We're able to get that on the commercial side because of our track record. Typically, you'd see commercial debt a little bit higher. But I mean, we're cash flowing fairly well, and it's about aggregating assets. We also have to remember that oftentimes interest rates don't stay where they are, especially at this level of pace, for too long. And I know a year or 2 or 3 might sound like a long time, but in the grand scheme of things, when you're thinking about a long-term investment, 5, 6, 7 years, it is a very short period of time. And history has told us that statistically, rates will come down. The Fed has indicated that they want to bring rates down. And I think if rates hit 5 or 6%, which many of you may even consider high because we were privileged with the 2s and the 3s, but 5s and 6 would be very normal. I think you'd see real estate prices shoot all the way up. And at that time, we can do a term refi and really unlock some fantastic cash flow.
That's great. Does anybody else have any questions from the group? And then if not, I think we have one other in the chat.
Anyone else here? Cool. I think that was just a piggyback question on the average fixed interest rate in Fund 1, which I would guess is similar then. But that was kind of the same question, more or less.
Yeah, and I guess the only one we missed, I think, Seif, was talking about fees. So property management fees, acquisition fees, rehab construction fees, disposition, where do we stand from a fee standpoint?
Yep. So I can't speak for the fund that you're investing into in terms of the fees that it has specifically. So I'll defer that to Stephen and Danny. In terms of what we do, we capitalize the expense of property management over a 5-year period, right? Which really allows us to unlock additional cash flows. So instead of charging a traditional property management fee over a 5-year period, we've subsidized that cost down by about 70%. And I think in the data room, you'll have your PPM. You'll have a model about how everything works. We're happy to answer any questions around those types of things, but I'll kick it back to Stephen and Danny in terms of fees in your fund if you have any.
Yeah, we run through a pretty standard 2% acquisition fee and then a 0% assets under management fee. So those are the only two that would mark up through our funds layer. Cool. Well, I know we're coming up on the hour. Again, appreciate all of you who have stayed this long and the kind notes in the chat, some of the direct messages as well. So certainly I posted something in the chat as well, a couple links to the data room. If you want to go look at portfolios, it's going to be very similar content between me and Danny there. So check that out. We will basically capture all of this then and shoot it out in a recording to everybody who looked at the fund and watched this recording. But with that said, I think we can wrap up. And yes, to answer that last question, Walt, it was about 6.5% average fixed interest rate in Fund 1 for those who are still curious. Cool. Thank you so much to all of our attendees today and look forward to talking soon. Thanks, Steve. Thanks, Danny.
Thanks, guys.
Thanks, everyone.